The Federal Reserve has two jobs. One is to have stable prices, to achieve price stability. The second is to achieve full employment. Today, the Federal Reserve has failed at both of those jobs. We have no price stability. We are seeing prices skyrocket. The CPI indicates a 5.4% increase in prices over the last 12 months. And if you take out food and energy, core inflation is at 4.5%. There is no price stability. The Federal Reserve receives a grade of F- on price stability. If you then take it and you look at and say, okay, what about full employment? The Federal Reserve is currently overseeing a labor market that has over 5% unemployment, which shows you that not only do we not have stable prices, but we also don't have full employment. So the Federal Reserve, again, fails to do the job that they are tasked with. And so if you're going to fail at price stability and you're going to fail at full employment, then you have to wonder, why are we devaluing the currency at such a historic pace? If we were devaluing the currency at a historic pace, but achieving the Federal Reserve's goal of price stability and full employment, you could make the argument that it was worth the devaluation for those things. I would disagree with you, but you could at least make that argument and you would appear to be rational. But when you fail at price stability, when you fail at full employment, and you continue to punish the 45% of Americans that hold no investable assets, you're simply failing. You are not achieving what you are tasked with doing. And so we've got this tweet from Sven Henrik that Matt just pulled up there, which says the Fed's secret plan to achieve full employment is to let inflation run so hot that even retired people will beg for jobs. Now, he's being facetious, but there's a hint of truth in every great joke. That is what we're watching here. Is literally, we are watching the manipulation of an economy. Today, the S&P 500 hit an all-time high. Congratulations to everyone. Let's get it. Let's do a little round of applause. Fantastic. Guess what? Rich people getting richer. If you're in the top 55% of Americans, you hold investments. You probably got some exposure to the S&P 500. Like a little rocket ship. Every week, new all-time high. You're getting richer, 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 richer. They literally can't stop. They're manipulating the market so much higher. At the exact same time that the S&P 500 is hitting all-time highs, the bottom 45% of Americans are absolutely getting slapped across the face, and they are getting punished because the currency that holds 100% of their wealth is being devalued at that historic pace. No full employment, no price stability, and a historic devaluation of the currency. Absolute madness. So yesterday, Jerome Powell was asked questions, and he had some ridiculous things to say. First, he starts out with a quote where he says, as the reopening continues, bottlenecks, hiring difficulties, and other constraints could continue to limit how quickly supply can adjust, raising the possibility that inflation could turn out to be higher and more persistent than we expect. Who's we? Who is we? That's what I want to know. Who is we?
It's him and his 100 economic forecasters that he has hired for him that are simply to estimate the economy.
They're just yes men. They literally just say, what is the Fed's position? Okay, let's go make models that are going to then explain why the Fed is right on this. They're wrong. We was wrong, but we the people, the common people, the people who literally pay attention all day and have to go to the grocery store and don't have somebody bring them their food because they're worth $50+ million. We knew this was going to happen, and we've been saying it for months.
But no one went to his office and told him.
Remember, if you don't go to Jerome Powell's office and tell him that there's a wealth
inequality gap.
Difference, inequality gap, whatever you want to call it.
I thought you froze there for a second.
It's like a glitch in the matrix. You just kind of if you don't go to Jerome Powell's office and tell him that there's a wealth inequality gap, it doesn't exist. So if no one goes to his office and tells him inflation's high, then I guess that doesn't exist either. So he didn't expect it. They didn't expect it. But anyone that actually lives in the real world knew this was going to happen. This was the most obvious thing in the world. Go back, check. Literally all over the internet is littered with market participants saying you can't print trillions of dollars and manipulate the interest rate down and not get high inflation. The second quote that he has is, indicators of long-term inflation expectations appear broadly consistent with our longer-run inflation goal of 2%. If we saw signs that the path of inflation or longer-term inflation expectations were moving materially and persistently beyond levels consistent with our goal, we would be prepared to adjust the stance of policy. Now, that sounds like a reasonable thing to say, but the most important word in finance today is the word transitory. And growing up, the word transitory probably wasn't even in your vocabulary. It's kind of a weird word. You haven't heard it too much, but when you hear it, you know what it means, but don't think too much about it. All of a sudden, the word transitory has been thrust into the lexicon of finance because they continue to claim that inflation is transitory. And so the most important topic in all of finance is inflation. How high will it go? How long will it go? And if you label it transitory and you continue to use that as the talking point, then people will start to use the word transitory. You are conditioning them to say transitory. Well, yesterday, Jerome Powell was asked to describe what does transitory mean? That's kind of a qualitative word. There's not really a way to quantify it. And so could you please elaborate on transitory? And this is what Jerome Powell said. And I really beg you to watch this and not laugh as you listen for the 2+ minutes where the chairman of the Federal Reserve tries to explain to us what transitory means.
That was hilarious.
Yeah. That's presented without comment. What is he talking about? As that tweet said, what in baby Jesus' name is this? What is going on?
Well, the hands were one thing.
Okay, so first of all, we should
That was
comment.
edited.
The video is definitely manipulated in terms of they use some sort of filter to do the ratio
head
up.
bigger, yeah.
Ignore that. That's not why we pulled up the video. That was the only video we could find of that specific period of the talk. But what he described was inflation may continue, but it may not. The prices may go up or they may come back. We don't know what's going to happen. And then at the end, he just says this, what transitory means temporary. I literally don't know what to say about that. So let's go to see what the experts say. Lynn Alden, who was on the podcast on Monday, explicitly said this on Monday and now followed it up with a tweet to that exact comment. And what she said is he's trying to admit the inflation being not transitory in absolute terms means that the prices that go up today are not going to come back down. When Chipotle increases the prices on their menu, they don't come back down. When Tyson Food increases prices, they don't come back down. When Domino's and every other restaurant and place that you go, the grocery store, etc., when they increase their prices, they're not coming back. There's nothing transitory about price increases. But in his view, transitory in the rate of change terms, meaning that yes, right now we have 5.4% increase in CPI from last year to this year in terms of June. He's saying that, next June, the rate of change won't quite possibly be 5.4%, allegedly. But what he's claiming is if it's 2 or 3%, that means that inflation has come down. No, it hasn't. Inflation just isn't accelerating at a faster rate, but inflation is still here. And that is the difference, is that they are using nomenclature to trick the American people. If you understand the absolute price increases versus the rate of change, you see that every price increase in your life that is happening today is not transitory. It is permanent. There are no prices that are coming back down. What they're talking about is the rate of change. They're saying it may be bad right now, but it's not going to be worse in the future. But they don't know that because the models they're looking at aren't accurate. The numbers aren't accurate. Jerome Powell, the Treasury, politicians, people in the economy, in the market, myself, my brothers, everybody. Nobody knows what true inflation is. Nobody knows. What we have is the official numbers that even the Federal Reserve says are inaccurate. Lynn then went on to say, I'll take how to say we kind of devalued U.S. cash and debt this year without saying we kind of devalued U.S. cash and debt this year for $500, Alex. That's essentially what we're watching here. This is absolutely bonkers. And that is why this is Inflategate, because this is absolutely a controversy. This is something that can no longer be spoken about in the sense of, oh, it's this finance concept. Inflategate is here and it is real. And what we are going to do is we're going to look back on this period of time and we are all going to recognize that we are living through a historic moment in financial markets where the bottom 45% of Americans are being punished, the rich are getting richer, financial assets are being pumped to the moon. The S&P 500 and the NASDAQ hit a new all-time high almost on a weekly basis. How is that possible with over 5% unemployment and with businesses that literally are still struggling to figure out how they're going to operate? It's because the markets are manipulated, and there's no way to deny that at this point. But maybe you could make the argument that if you had a devaluation of the currency, if you had a low interest rate where there was cheap capital that was flooding the market, and you had growth in the stock market, then you could make the argument, well, it's because the economy is growing, and we're doing our absolute best to hit all of the metrics that we need in order to signal strong growth. And that, again, could be a rational argument. Maybe it's one that I wouldn't agree with, but it would be at least something that I could understand how somebody could make the argument. And so economists and Wall Street analysts and people who build models for a living and do all sorts of stuff, they probably have pocket squares or pocket protectors with their pens and pencils in it. Definitely have cologne on, probably slicked back hair, the whole 9 yards. Their expectation for GDP growth in Q2 was about 8.5%. That was the expectation. That was the forecast. That was their estimate. This is what they do for a living, is to estimate this stuff. GDP growth came in at 6.5%. They missed by 25%. How the hell do you miss by 25%? That is your job, is to estimate this stuff. You spend all day doing it, and they missed by 25%. Expectations and estimations on Wall Street and in the economy are merely astrology for adults. That's it. That is all this is. Liz Saunders, quite the miss by economists. You have now incumbents. You have people who are well-respected in the economy saying, whoa, that's a pretty big miss. 25% or so. They missed on second quarter GDP. And so when you look at it, you start to understand, yes, there is growth, but that growth is nowhere near what we would expect given the devaluation of the currency, the cheap capital flooding the market, and the downside of all of the monetary and fiscal policy decisions that are being made.